Yeah, hi. So we have completed in the last videos different types of costs, and we talked about variable cost, fixed cost, direct cost, indirect cost, and how to calculate fixed cost and variable cost if we know the total cost. And also we discussed about different types of cost. So here today we are going to discuss how the cost will be flowing in a manufacturing environment. So you can imagine you are in a manufacturing company and you will have different types of costs here, right? So you will have material cost, which is a direct cost for us, and we will have labor cost, that's also direct cost for us, and you will have all the indirect cost. So now imagine you are buying a lot of things in this manufacturing company, you can see in the screen, and you are producing, for example, 40 units of product A. Okay, so it is an hypothetical situation. You are imagining I am producing 40 units of A. So A is our product. So when you are making this, you know that to make A, I need so and so material and I need so many hours. So you can take this cost and you can add to that product easily. But what you will do with your rent paid, or the insurance paid, or the salary for the supervisor paid, all these you cannot directly attribute to the product, right? So how we will do that, that is what we are going to see here. So you can see this diagrams here. Now it is only columns, sorry, now it is only squares we can say, but it is going to be a cost flow soon. You can see here in this company you are buying materials. Okay, so you are buying material. What's the price of the material? $5. It is mentioned here. The price of the material is $5 and you bought 1000 units of raw material. Okay, so normally what you will do, you will debit raw material and you will credit cash. So you have done that. Okay, now what you will do, you will issue this raw material for production. Okay, so that's what you are going to do next. Now you are issuing this raw material to production, but you are not issuing all the raw materials, right? You have to issue only the raw materials required to make 40 units of A. This is what we said. So imagine that cost is like 100 raw materials you needed to make 40 units. So $500 now you have to move from raw material, and this has to go and stay in work in progress, right? Because now the work is started. So whatever the goods are there in the raw material, that is being issued by the storekeeper of the raw material to the production manager, because production manager is telling, I want to make some goods now, so I need 100 units of raw material. So when they issue, it is easy, you will debit work in progress and you will credit raw material. So you can see here $500 now came and stayed in work in progress. This is easy for us because we know how many units we need to make 40 units of A, and what is the cost of that also we know. So we can simply debit work in progress and we can credit raw material. Okay, so that we have done. This is for direct materials I'm talking about. Same like that, we have payroll, or we can say direct labor. So direct labor, imagine to make that 40 units of A, we need 50 labor hours, and every labor hours will cost us $8. So total our labor cost make this 40 unit is going to be $400. So that also we can directly put in work in progress, because we know whatever amount we spent, we can debit work in progress and we can credit cash. So that amount also went into work in progress, that is like $400. So these two things are easy now. Now what you will do with your indirect or other overheads? Like you paid rent. So rent for an year is say it is 40,000. So how you are going to allocate that 40,000 to the units you produced just now. It is only 40 units you produce, right? So how we will do that? That is what we are going to see in the coming animations, we can say. So raw materials, direct and direct labor, it is directly went into work in progress. Now all the indirect materials and indirect labor, all other overheads, everything will not directly go to work in progress. It will go and stay in a temporary account called overhead control account. So all the indirect cost will go to overhead control account, or we can say we will debit overhead control account when we pay indirect labor. We will debit overhead control account when we pay rent. We will debit overhead control account for all the expenses what we incurred other than raw material and direct labor. So that's what I am going to show here. Now raw material, indirect material will go to overhead control account. So you will debit overhead control account and you will credit your indirect material or raw material from the raw material store. When it is indirect labor, that also it will be going to overhead control account. Again, other overheads, it will go to overhead control account. For example, depreciation, it will go to overhead control account. So now all the amounts are in overhead control account. So you paid rent, for example, 5,000 KD or $5,000. You paid depreciation, sorry, you didn't pay, you allocate depreciation of $10,000. And other overheads are coming $5,000. So how you are going to take this amount and allocate for the 40 units what you have produced? We cannot directly add all this cost to that 40 units, right? So what we will do, we will formulate something called POR, which is predetermined overhead rate. POR, predetermined overhead rate. What is this POR? We will see here. You can see from the beginning of the year, I have decided or I estimated that my total overhead, including everything, my total overhead for the year is going to be 100,000. Okay, including rent, including insurance, including supervisor's salary, whatever it is, your overhead for the year is going to be 100,000. And you are going to make 5,000 units. Okay, so you are spending $100,000 in terms of overhead and you are going to make 5,000 units. So to make one unit, how much overhead you needed, that we can calculate, right? So this $20 is what actually you needed to make one unit as per my estimate. My estimate can be wrong, it can be right, that we are not discussing now, but as per my estimate, or we are assuming that my estimate is accurate now and it is $20 I need to make one unit of $20 in terms of overhead control account. Now all the cost when we paid, everything has come to overhead control account, right? We debited overhead control account for all the amount. Now from this overhead control account, for the 40 units what we produced, and the cost for this 40 units has to move from overhead control account to work in progress because we are working on it, right? So what we will do, this is going to be our predetermined overhead rate. We said to make one unit of A, I need $20 of overhead. Now what we will do, we will take overhead control account which based on POR, and we will take 40 units we have completed. So multiply that by $20, which is our POR. That much amount will go to our work in progress. So this is how the total cost will move to work in progress. So first everything will be going to overhead control account. So you will be debiting overhead control account and you will be crediting cash, for example. Then when we are transferring this amount from overhead control account to work in progress, you will debit work in progress for this 800 and you will credit overhead control account for this 800. So now in overhead control account you have a debit in which or for which we have actually paid. and the credit is going to be how much we have transferred to work in progress, or we will see how much we applied to production. So the word application is important. We applied. Okay, so we applied $800. Now we know that total cost is going to be 800 plus 400 plus 500. So it is 1,700. So you have now $1,700 you totally spent for making this 40 units of product A, and everything is now in work in progress. Now when the work is completed from work in progress, what will happen? This cost will be going to finish the goods, or the item will be moved to finish the goods. So you will debit finished goods inventory and you will credit work in progress for how much? For $1,700. So now all the cost has gone to finished goods. Now when you solve these goods, you don't have that goods with you, right? So you have to credit finished goods, and what you will do, you will debit cost of goods sold. So that will report what is the total cost of the 40 units you have sold. So only at this point, the total cost, whatever you spent, or total amount of material used is reaching your cost of goods sold when it is sold only. Sorry, it is reaching to income statement. It is reaching to cost of goods sold means it is reaching income statement. So till that time, where is it staying? It is in the balance sheet. It is in the balance sheet in what form? First, it was in the form of raw material. Second, then it was in the form of work in progress, and finally it was in the form of finished goods. At all this time, all your cost was lying in the balance sheet in the form of inventory, though it was termed differently, like raw material, work in progress, and finished goods. Once it is sold, then you will debit cost of goods sold. That will go to income statement, and you will understand what is the cost of the items I sold only at that point. So if it is not sold at this moment, then what will happen? Nothing will be going to income statement. So all the cost you carried in inventory. Now you understood why it is called as inventoriable cost, why product cost is called as inventoriable cost. All this cost we have added to inventory, and inventory is shown in the balance sheet, and when it is sold, at that time only it will be going to your income statement in the form of cost of goods sold. So this is the cost flow actually happening in a manufacturing company. Okay, I hope you understand this, and if it is better, we will go and see how the journal entries will look like for this flow. First, we bought raw material. So raw material will be debited, and it was a credit purchase, so you will credit accounts payable. So this raw material is now in your raw material store. Now what is happening? The second is like the production manager is telling you, I need to make 40 units of product A, so give me material. So when I am giving material, I will credit raw material. As a raw material store manager, I will credit that, and I will add direct material to work in progress and indirect material to manufacturing overhead control account. So I will be debiting work in progress, that is for direct material, and indirect material I will debit overhead control account. This is about material. So you can see here the diagram, summary of cost flows. When you are purchasing material, it is going to be debited here. Then from this, direct material will go to work in progress, and indirect material will go to manufacturing overhead control account. Okay, so direct material to work in progress and indirect material to overhead control account. And what will happen to your labor cost when you are paying? Actually same, work in progress is debited for the direct labor cost, and the indirect labor cost will go to overhead control account, and you will say cash you will credit, or maybe wages payable you will credit. So you debited work in progress and you debited manufacturing overhead, but that is for the indirect labor. Direct labor you debited work in progress. So again, now you can see how the direct labor will be going. You can see here, before we debited work in progress, now we are debiting direct labor in work in progress to get the total cost of material and labor. Same like here, indirect labor cost has gone to manufacturing overhead control account. So you can see here, direct labor has gone to manufacturing overhead control account, and indirect labor has gone to manufacturing overhead control account. Sorry, indirect labor and indirect material has gone to manufacturing overhead control account, and direct material and direct labor cost has gone to work in progress. Now we will have a lot of other overheads. So all the other overhead, we will debit manufacturing overhead control account. That control is missing here. Overhead control account for all other expenses. Maybe it is tax payable, it is insurance payment, or it is depreciation. So whatever it is, you will directly debit manufacturing overhead control account. So now in overhead control account, you have three things, right? You have indirect material, you have indirect labor, and all these other overheads. Okay. Now, when you produce this 40 units, what you will do, you will move the cost of that 40 units to work in progress. From where? From manufacturing overhead control account. You will move that from work in progress, manufacturing overhead control account to work in progress. So you will credit overhead control account and you will debit work in progress. Now all those three costs, it has come to work in progress account in direct material, indirect material, and direct labor and indirect labor and overheads. All three categories, it has come to your work in progress. Now, when you completed the production, now the goods will be moved to actual finished goods store. So we have to debit finished goods inventory. So all the cost now debited to finished goods inventory, and you will credit work in progress. So now there is no work in progress, right? It is completed and transferred to finished goods. So you will credit work in progress and you will debit finished goods. Now when you actually sold, you will credit finished goods because now it is not with you. Goods are sold. And you will debit cost of goods sold. At this point, the cost will go to your income statement from balance sheet. Okay, so at this moment only cost is traveling from balance sheet to income statement when you actually sold it. So imagine you bought the raw material last year and you are selling the goods this year. That means the last year cost actually coming to income statement only this year. Okay, so this is what we should understand, and that is the cost flow of a simulated manufacturing company. I hope you understood this, and now we will start calculating the total cost that is going to incur in a manufacturing company. So as we mentioned, in a manufacturing company we have three costs. One is material, labor, and overheads. So if we get all these three costs, this is what is going to be our total cost, right? So first we will see how we will calculate or how we will get this material cost. So here material cost or direct material used for the production, that is what we have to calculate, right? How much raw material or how much material we have used in the production. To calculate that, we have this formula, or we can think like this. Okay, we have to know how much we used in production, right? That is what we have to know. So what we can do, we can go and check. We will see how much we purchased, correct? How much we purchased during this period. And when you are bringing these goods, how much you spend in your transportation, that also we will be adding to the raw material cost, right? Normally we call it as landed cost. So to bring these goods to your store, how much you spend. So this will be added to the value of the inventory. Okay, so how much you purchased and how much transportation in you spent, and was there any returns, then you have to minus that, right? During this period, was there any return, that you will minus. Okay, so this way you will get actually how much you purchased during the period. This is the only thing you are getting now, right? If you take all these things, you will get how much you purchased during the period. But how much you purchased during the period doesn't mean that you used everything, right? You cannot say that whatever I purchased I used. No. So what I will see, I will go and check in the factory. Okay, and I will see, oh, there are some items, it is still there. So whatever I purchased is not used. So what is my aim is, I want to know how much I used. So still some items are there which I didn't use. So what I will do, I will take the total purchases. So we will check first how much I purchased, then I will check how much I don't use or still it is there without using it. So we will minus that. That's what ending material we will reduce from that, from the purchases. Now, oh, you remember, oh no, there was some beginning items, beginning inventory at the beginning of the period. So not only the goods I purchased, I used, there was some goods, it was there when I started the period. Maybe January 1st, there was some goods. So that I have been using all throughout January, right? So what we have to do, that we need to add. So we can say 10 units was there in the beginning and 100 units I purchased. So how much I can use in total? 110. So now I want to know how much I used. So what I will do, I will go and check how much I have in the ending inventory. I have 20. So 110 I have and 20 is still there. That means I used 90 units. So this is what, or this is how you will calculate how much material we used. So nothing but beginning inventory plus purchases minus closing inventory. And you have to adjust the purchases for transportation in and returns and all. So this way you will get direct material used. Now next slide is going to tell you we have to calculate cost of goods manufactured. So what is cost of goods manufactured? This is the cost of the goods actually we manufactured, means actually we completed, we made some finished goods, and we have to calculate the cost of that. So what we will do, we will take direct material used. We know how to calculate this from the previous slide, and direct labor that we can get from our records, how much labor cost we have. Then we will take manufacturing overhead applied, and we know that for the last 40 units how we applied the manufacturing cost. All those three things we will add: material, direct labor used, and manufacturing overhead applied. So this, if you add all these things, we will get something called manufacturing cost. So this is the total cost incurred in the manufacturing unit. That doesn't mean that this is the cost of the goods manufactured. Cost of goods manufactured means this is the cost of the goods actually completed. And manufacturing cost is the total cost incurred till now. So we spend a lot of money in material, labor, and overhead we applied, but all this cost or all this process is not yet completed. Maybe we have started with 100 units, okay, but we completed only 40 units. In a hypothetical situation, we started with 100 units and we completed 40 units only. So what does that mean? All the cost incurred here is to manufacture 100 units, but we didn't complete it, still work is pending. So what we will do, from this total of 100 units, total of this amount, we will minus ending work in progress and we will add beginning work in progress. Same concept we have seen in direct material used, calculation of direct material used. So to the manufacturing cost, we will add beginning work in progress. Why? This is the total cost incurred during the period. But when I start the year, there was say $20 in work in progress. So when in January 1, when I'm opening my factory, there are 20 units, it is half completed or not fully completed. And there are some cost into it, right? So that cost you have to add to the current period total cost. So if you add these two, you will get total 120. So now this is your cost incurred during the period, but all this cost you incurred for the finished goods? No, all the cost you incurred, but out of this some cost is still lying in the factory because some of the goods are not yet completed. So what we have to do, from this 120, how much is there still in work in progress? That we will minus say $30. So 120 minus 30, we can say my cost of goods manufactured is $90. So this is how you will calculate cost of goods manufactured. Nothing but you will calculate the total manufacturing and you will adjust for opening and ending work in progress. Then you will get cost of goods manufactured. Now this is not enough. We don't have to get cost of goods manufactured, but we have to get what? We have to get cost of goods sold. So now we know that I produced so and so units, but all this unit I sold? No. Correct? So what we will do again, we will take cost of goods manufactured first. So we have to find out how many units sold. So we will check how many was there in the beginning when we started. So again, beginning when we started there was 50 and during the period we made 100. So total 150 is there. And now you go and check how much is there in ending inventory. It's only 10. So 150 was there. Now I can see only 10. That means I sold 140. Correct? I sold 140. So 100 I made during the period, 50 was there in the beginning. Total available for sale is 150. Now what is left is $10. That means I sold 140. And this is what actually the cost of goods sold. So again, how you will calculate it? Cost of goods manufactured. How we will calculate this? That we can see in the previous slide. Then you will again adjust beginning and opening inventory. Then you will get cost of goods sold. But if you are not in a manufacturing company, for example, if you are a retailer, so instead of cost of goods manufactured, you will use purchases. If you are a reseller, for example, you will use purchases instead of cost of goods manufactured because you are not manufacturing anything. So this is how you will calculate the cost of goods sold. So here, to answer your questions, you have to remember one thing, that from beginning, everywhere beginning direct material we are adding here, okay, and work in process we are adding, and also you can say beginning finished goods. So all the beginning inventory we are adding and all the ending ending inventory we are reducing, we are deducting. You can see the first ending inventory reduced, here also ending inventory reduced, here also ending inventory reduced. So this keep in your mind. Sometimes you have to do a calculation of cost of goods sold. You don't have to follow the steps what I have shown you, because that is going to take a lot of time. So if you want to think smart, you will just take all the inventory, add everything and minus all the costing. Then you will go for the rest of the information what is given in the question. like how much purchases, how much returns, all those things you can add later. Anyway, we will do the question at that time, we will see that. So here in short, we will add all the beginning inventories and we will minus all the closing inventories. So these are the formula to calculate cost of goods sold. Finally, how it is going to income statement. So beginning inventory plus purchases plus transportation minus returns, then minus ending inventory. Then you can see direct material used, labor used and overhead applied. You will get manufacturing. Again, plus beginning minus ending work in progress, you will get cost of goods manufactured. So we have to remember, manufacturing cost and cost of goods manufactured is not same. Manufacturing cost means how much cost incurred during the period. Cost of goods manufactured means this is the cost of the goods actually completed in your production, or this is the cost of the finished goods. Now when you are selling it off, you will take the manufactured cost, then add beginning and minus ending. You will get cost of goods sold. But we are ignoring something like if you lost some goods or some goods are stolen, those things are not covered here. Okay, we are not considering all those things. So this is how the cost will be moving from one point of manufacturing process to the last point of manufacturing process. Okay, hope you understood this, and thanks a lot for watching.